We believe that political risks have receded so far this year. In Britain, obviously, the situation is still very fluid, but we believe that based on the latest events, the Parliament will either accept Mrs. May's deal, a less likely scenario, or craft a deal of its own in the next 12 months, which will be even softer. In Italy, the shift in the balance of power in regional elections and in polls between the Lega and the Five-Star movement is actually lowering the probabilities that Five-Star will be able to implement some of its more problematic measures, such as big spending plans that could destabilize the Italian bond market and even ignite a new euro crisis. And then turning to Spain, we believe that the snap elections to be held at the end of April will most likely produce a right-wing government that will reintroduce sound mainstream economics in the country. Yes, there is another big positive development, which is the shift to a dovish stance of key central banks around the world. Namely, the ECB and the Fed have signaled that they are ready to ease monetary policy should the economic slowdown that we can see on a global basis accelerate. And this is a positive development. It is indeed a big risk. So the global economy is slowing everywhere, and most strikingly in Europe and especially in Germany. Germany has been severely hit by a confidence crisis in its key automotive sector. On top of that, Germany, which is a very open economy, is overexposed to the slowing international trade. Turning now to China, we believe that the slowing down of the economy in this country is not only the result of trade tensions with the US, there are also structural drivers behind the slowing down of the economy. And those drivers can only partially be offset by the communist leadership if it doesn't want to boost the financial leverage of China to a too dangerous level. So far, the US economy has largely been spared by the global economic slowdown. But we think there are reasons to believe that they will be impacted as well over the next 12 months. As a result of the global economic slowdown, expectations for corporate profits are declining, which is a headwind for the performance of equities. And with equity valuations already materially above their long-term average, we don't think they can be sustained in the face of declining earnings expectations. Looking at the numbers, profit expectations for the next 12 months are down 5% compared to peak expectations of September 2018. The earnings season of the fourth quarter 2018 was the worst earnings season in 4 years, with profits contracting 4% year on year. Our outlook is rather bearish. While European political risks have receded, and while central bank guidance has become more supportive for equities, we believe that there are still potent risks that could weaken the equity story. Those risks are the unabated global economic slowdown, the unresolved trade dispute between the Chinese and the Americans, falling earnings expectations, and too generous equity valuations. For all those reasons, we believe that the defensive equity positioning that we adopted in our European portfolios in the middle of last year is still very much warranted.